That's why the education part of this, guys, is so important. Like, know what you're looking at. All right, you don't have to be an expert, but know what questions to ask, know what things to look up. Like, go into these types of things assuming that there's something not there's there's a catch to this. All right, should always assume that it's not always going to be the case, but if you go into it with that mindset, then you're going to be much less susceptible to products like these because you're going to know what to look for, the questions to ask, the research to do, and you can start to put the pieces of the puzzle together and then make an informed decision. What's going on, my fellow wealth creators? Matty Ice here. I've got my good friend Michael Garcia from IC Life again, and we are going to be picking apart and destroying this really crappy fixed index annuity. And we've done a lot of videos about IUL, but there's also a really big problem in the annuity industry as well with this promise of upside potential, downside protection in the market, and using these proprietary index like volatility controlled indexes that look extremely good on paper and then provide subpar results, is putting it nicely. And what we're going to do is Michael's actually working with a client right now that has a fixed index annuity from F&G, I believe it was. And we're going to go through the actual statements and see the interest credits and the significant reduction in participation rates and all this stuff that have a massive, massive negative impact on the long-term performance of the annuity. That's another thing we're going to talk about too. I'm going to at least share, I want to share my thoughts on that. I want to hear your thoughts as well, Michael, about trying to use annuities to as a wealth accumulation vehicle when they're not really designed for things like that. But we'll get into that as well. But the main thing is what that we want to accomplish with this video, guys, is to open your eyes and get you to understand that even though something looks really good on paper, that doesn't mean that's what's going to happen in reality. The fact is that a lot of these things in these contracts can change when they're promising all this upside potential, downside protection in the market. You have to be really, really careful with this stuff. And these proprietary indexes are getting into some really hot water. There's some pretty massive class action lawsuits going on with some life insurance companies right now because of the extremely, extremely misleading nature of the illustrations of these volatility proprietary indexes that are supposed to outperform the market. We're going to show you that it's literally the exact opposite. Okay. So with that said, Michael, I appreciate you being here. I appreciate you reaching out to me to share this with people. I know some of the other videos that we've done have been, they've been getting out there and people have been reaching out, and which, that's why we do this. So I really appreciate you being here, man. I'm looking forward to this.
Yeah, me too. And yeah, I've gotten emails from people, reaching out saying, "Hey, can you take a second look at where I'm at?" And so
Yeah.
it's good to know that we're making an impact, Matt.
Yeah.
So I'm super excited to do this. Just continue to get the education out there because, yeah, there's people getting ripped off left and right. you
Right.
know,
It's sad,
whether
man.
it's IUL, whether it's an annuity. Um, I think those are the easiest products to really take advantage of people because the carriers themselves are putting together these illustrations that are manufactured, right? They're engineered to look
Right.
good on paper.
Right.
And so it's really easy for an agent or somebody that, just wants to make money and say, "Hey, I want to become an agent because I can sell that." Right. And they're
Mm-hmm.
just going to hold that paper up and say, "Well, look at this."
Right.
But they have no idea about investing, right? They have no idea how the product even works.
Right.
Um, and what
That's
I've
the moral
seen,
hazard side of it right there. You get somebody that comes in that's really good at selling, doesn't really understand what they're selling, but it has massive, massive implications on people's finances. It's really bad.
yeah, and that's what's causing the issue with the IULs, right? Like people are selling it as retirement vehicles. They're selling it as uh, be your own bank, as permanent products. They're selling it
Right.
as things it was never intended to be, right?
Right.
And
Yep.
it doesn't make the product itself bad. It just means that it's being mismarketed and sold. Um, and because it's being missold, it's not going to do what people are hoping it was going to do, right?
Right.
And so it's not that the product doesn't do what it's supposed to do. It's just not going to do what they told you.
Right.
And so there's a big difference there. You need to understand that, hey, this is how this product actually works. And so that's
Right.
why I'm super excited to get this information, because I want you guys to see like how these products actually work,
Hmm.
what the true expectations are. Again, I sell these products. They're not bad products, right? But they're not meant to do what what they're sold, or they're not gonna do what's being promised out there. What I've seen in a lot of sales pitches on in the internet, on TikTok, on Facebook,
Right.
and so yeah, it really can throw your whole game plan off, right? You think you're gonna do this in retirement. They told you this, and you find out, well, that's not what I have. That's not how it works, right? And
Yeah.
so,
Not even
um,
close. It's incredibly misrepresented, and like we were talking earlier. I mean, a lot of times the agents just don't even know. But like it's like you have a duty to do it, and just a little bit of research. Like some of the things we're going to show you guys in this video, it doesn't take a lot to start to pick these things apart a little bit and start to see that there's some red flags here. Like they're telling me that the illustration is showing Michael. I've seen you did a video with Tracy. I've seen some of his videos where he's showing some of these proprietary indexes showing 12, 13, 14% on the illustration when the
yep.
index has only done like 3 or 4. And then the argument is, oh well, you get a 200% participation rate. Well, you're going to see in this video when we go through the statements, those change very, very frequently. And
Mhm.
just one last thing I want to say about IUL with this, because this is really interconnected here. Like the product doesn't really matter in this particular case because it's happening with both of them, IUL and annuities. But here's what happens: is they sell you a really good cap rate, participation rate, whatever, and then they change it later on down the road. So
Yep.
even if like one of the things that we get pushback on or about from agents is it's not designed correctly, right? But here's the deal: like it doesn't matter how you design it. It does help, but you're assuming that everything that you designed is going to stay the same and that the life insurance company isn't going to change anything, but they do. So you could have a perfectly designed fixed indexed annuity or IUL or whatever. But if that life insurance company comes in and drops your cap rates, participation rates, whatever, then the whole thing is like the original illustration just goes completely out the window. Right. So that's what we're going to show you guys in this video. So, Michael, do you want to, you think, like, where do you want to start with?
Well,
Like, maybe give some context on
well, I want to kind
how
of like emphasize that point, right? And I will say this:
before it.
the IUL side has some regulation, right? It's not enough, but there's some limits to what they can show, right? So on
Hmm.
the fixed index annuity side, they don't have an AG 49
Right.
regulation, or 48, 89A and B, right? So on the fixed index annuity, they're showing you like 15%,
Yeah.
20%.
I've
It's
seen it,
actually pretty
man.
ridiculous when
It's
you look at it.
crazy.
Um, and so it really is just discussing, and also they're a lot quicker to drop the rates on the annuity side versus the IUL side, although it happens on both. um, and so you're going to see the renewal rates of a policy 3 years in, and you're going to see what the rates are for a brand new policy, and you're going to see a pretty big difference there.
Yeah.
um, and so and the same thing happens in IUL too, right? Like
Hmm.
they block the business, and then all of a sudden the new business gets the higher rates and the old business gets significantly lower rates, right? And so
Right.
that's the thing, when the reality is you the agent, if you're getting pushback, or the agent saying, well, properly designed, well, let me bring up 2 points, Matt. Number one, what did that agent have to do with the design, right? Who designed that policy, right? Who created the language in the contract, right? It was the insurance company. It was
Hmm.
their legal team. It was their actuaries, right? They designed the product, right? Someone really smart at the company designed the product, not the agent. So for
Right.
an agent to, number one, say, well, it's the design of the policy, no, they're all designed before the agent touched them. They're designed by the carrier. They're executed by the carrier, right?
Designed
And
to
so
be
it's
changed at any time.
and the language is written in the favor of the insurance carrier, right? So they can protect
Yeah.
themselves and change. And I'm actually going to get into the financials here too, Matt, because when you understand that, you realize like you need to have a carrier with great financials, otherwise you're in trouble, right?
Mhm.
And so this company that we're going to show doesn't necessarily have great financials.
Right.
Um, and so
Interesting.
that's the other part of it too, right? So the agent saying, well, properly designed, first of all, that's pretty much bogus, right? Um, by the way, they're implementing that they're doing something to fix the policy after the carrier designed it because there was an inherent flaw with the policy.
Right.
So they're admitting an inherent flaw with the policy, so to speak. And they're basically saying, well, if we put more money in it, because it's not the design, it's, hey, let's fund it more, let's throw more money at it. They're saying, well, more money solves problems. You know what? Sometimes it does, right?
Yeah.
Sometimes more money does solve problems, but sometimes it doesn't too, right? Sometimes you just ends up being a money pit and you lose more. So,
Right.
um, so that's one thing.
Just to play devil's advocate for just for a second, because I can see the comments coming in from this already. Like, we've seen some pretty awfully designed, like very really poorly designed policies. So, I do want to stress that that is important, but it doesn't really matter at the end of the day. It's not as important as agents will make it out to be, because of the fact that
Yeah.
everything can be changed. Like, it doesn't
And I
mean
think,
go out and get like a horribly designed policy, but you have to understand how the nature of the contract itself is set up to be changed by the life insurance company. And it 9 times out of 10, it usually does. And then everything just goes right out the window. So
right. And
that's
Matt,
what you'll see here.
and my counter argument to any kind of design is this: if you have a policy with a $50,000 death benefit, living benefits in it, and it's being funded at $500, and you have another policy from the same carrier, same company, same death benefit, $50,000, same living benefits, but this one's being funded at $100, is there a difference in that design?
Is there a difference in the design? No, because the same amount, you can put the same amount of money in,
Right. And so
right?
that's
It
my
comes
point
down to how
is,
it's funded.
yep. So there's
Right.
there's a funding thing, but there's no design thing, right? So the
Yeah.
any agent telling you it's not properly structured or it's not properly designed, they don't know what they're doing.
Yeah.
Pretty
It's
much
fun
is
stuff.
what I want to say. Um, and I do know a couple good agents that use that terminology. I try to tell them like, why don't you use properly funded, properly managed? Because you do need to
Mm,
manage those policies because they
sure.
are liquid. They are not liquid, but they change, right? They're
They're
variable,
fluid. Yeah.
right? And
Very
so
fluid.
you got to stay on top of that. But the second thing is this: when what we're going to see in this video is an annuity, right? So when agents talk about properly designed, what they're talking about is minimal cost of insurance, right?
Hmm.
Minimum coverage, max funded, right?
Right.
And so what's cool with an annuity is it's max funded. There is no cost of insurance,
Right.
right? And we're going to see that there's still issues,
Right.
even even
So
so,
you don't
right?
you
So,
don't have to worry about it necessarily lapsing like you could with an IUL, but there's still massive problems because this product is now massively under delivering what was promised to you,
yep.
right?
So
So that still
yeah,
creates its own massive set of problems, especially if you're making long-term financial plans around this decision. Well, how are those plans all of a sudden need to be changed because this product isn't doing anything close to what was promised? So
yeah. Let
you
let's get
gotta
in, let's get into it.
all right.
Um, so I
Let's
got
pull it up here.
so I have
Yeah,
a policy.
walk us
This
through
is a
this.
yeah. So you can see the screen.
Yeah.
Okay, so this is a F&G. It's the power accumulator. By the way, F&G is one of the most popular companies. I can't figure out why they just market well, I guess.
Mm,
They always say it's not the best product that wins, it's the best marketed. And
sure.
um, F&G is in with a lot of the major, kind of the what some people would call the MLM structured agencies, where you have a lot of
Mm,
brand new agents just selling stuff that they don't understand and whatever
right.
pays the highest commission, right? And that is
Right.
one thing F&G does is they do pay the highest commission. When I look at like my compensation grid, the F&G annuities are 1% or 2% higher than pretty much everybody else from a compensation standpoint. So Pretty sure that's why the agents sell it, not because it's the best product. But I do want to pull this up real quick. Let me, and this is something you can do with any, if you're looking at an annuity, I would type
Oh
this
yeah, the
in, like
Comdex
F&G
score.
Comdex.
Yep.
And so this is a site that I will just pull up.
Does it, so it just, what does this do? It lists out all the Comdex scores for all the life insurance agencies or life insurance companies?
Yeah, so what I'm doing is I'm looking at the financials, right? And I want to see where they stand. So here we are.
Annuity Advantage.
So I go to this site, Annuity Advantage. I like it because it's a third party site, right? I have a thing, you want to verify things third party.
Sure.
Because you ask somebody directly about themselves and they might lie to you, right?
Mm-hmm.
But anyways, this is the number I look at. And this is also why I'm kind of weary of just looking at just the ratings themselves. When you look at this asset to liability, you look at the assets, $47 billion, 47.6.
Yeah.
But when you look at the liabilities, 47.7, right? So you look at this asset to liability ratio, Matt, they're on the wrong side of 100, right? They
Yeah.
have more liabilities than they do assets. And so when you consider the fact that they only sell, and this might be why they're an A, right? Because they're not in any danger. Because when you only sell IUL and FIAs, these are contracts that they put all that risk back on the consumer, right? They can, hey, if we get in trouble, we're just going to change the
Right.
fees in the
So they
policy.
could,
We're going to change the
so
cap rates.
they can manage these liabilities a lot better. They can stretch themselves a little bit more because they know they can go back and change the contracts if they need to, if things, if it
Yep.
gets too bad. Yeah.
Yep.
Wow, that's crazy.
They do have some guaranteed income contracts, but keep in mind, a lot of what they sell is the accumulation where everything's
Right.
subject to change, right? And they
Right.
can take more money from the client. So even when they do their IUL underwriting, they don't do not the full underwritten products. A lot of their products being sold are the simplified issue.
Yeah.
But again, you can
Instant
do that.
approval crap. Yeah.
You can take on extra risk when you can just change the contract.
Sure. Makes sense.
Because you're not
Makes
in
good
any
sense.
danger. It's the client that's going to suffer, right?
Right.
But this is the risk
What's
you're taking on.
what's their, scroll down a little bit. What's their Comdex score? Was it 70?
70.
Woo. I don't know. That's kind of low for a life insurance company, man.
Yeah, well,
I mean,
it's
like
a
compare, like I guess maybe it's not a fair comparison. I don't know, but like the companies that we work with, like setting up whole life policies and stuff, we're talking like 95, 96 Comdex scores.
yeah,
It's
yeah.
not even
Like
close.
I write a lot of Mass Mutual. They're 98, right?
Yeah.
Um, Again, somebody has to be at 70, Matt. The Comdex score is based on their competitors. I kind of think of it like when
Okay.
you took a test or like an assessment in grade school and they gave you a number and it was not necessarily a score that you got on your test, but it was what percentile you were versus
Right.
your peers.
Right. That
So
makes
what
sense.
they're saying is there's 70 versus their peers, right? So
I
compared
got
to
you.
the Mass Mutual, they're much lower. Compared to some of those companies, yeah, they don't compare, right?
Still something to be aware of, though. You know, if you have the option to do business with a company that has a far better Comdex score, meaning they probably have far better financials, why wouldn't you? I mean, always do your research, and you know, maybe F&G annuities are more competitive. You know, that's very possible,
Here's
but you got to do your research.
here's how I look at it, Matt. Your assets and liabilities, right? You got somebody who they have more liabilities than they do assets, and it's like being in debt, right? And
Yeah,
so you
I
have
just gotta
that
ask myself, like,
versus
how long is that sustainable? You know?
you have a company like Mass Mutual, right, where their ratio is, I think it's 112, 113.
Mm.
So they have plenty of assets to cover their liabilities. I look at it this way, right? If you have two friends, right, you got your money, you need somebody to hold your money. You have one friend that's in debt that you look at their financial picture, it's like you're barely making it, and then you have another one that's financially strong, right? Like
Right.
they're not going to need to touch your money. And then not only that, but you you put some variables in it, you give them complete control. Which one would you want to put your money with?
Right.
Right.
You're just you're stacking the red flags against yourself, pal.
Yeah. Yeah. And so that's why I'm surprised how much popularity that this company has. But again, I'm pretty sure it has to do with the fact that their commissions are higher. Right.
Yeah.
But when you look, what I really wanted to get at is these are actual statements, right? This is not a hypothetical illustration I'm going to show you. We're going to go through the first 3 years of this annuity and how it's performed, and then what the future outlook is, right?
Right.
And so when
So
we
which
look
one
here,
is this? Was this the first year?
so this is the first policy statement, right?
First policy statement. I got you.
So when he started this policy, the initial premium, you can see right here. I'll zoom in a little bit, but you can see it was 105 2, right? 105,220 bucks.
Mm-hmm.
So at the end of the first year, so that was 2021, and then 2022, he didn't get any interest credit, right? Now there was a down year there, right? You look, there's fees. So the other thing is they put the charge, and we'll get into this, Matt. I'm a believer in not using those accounts that have the charge in it.
Mm-hmm.
They typically don't make sense to me, but this one
Real
does
quick,
have.
Michael, on that, those extra charges aren't those typically used with like multipliers, and it gives you like higher participation rates and stuff like that? Is that what those usually are?
Yeah, here's the issue, right? So I've seen some that completely mathematically don't make sense. So it's not, don't ever use it, but beware, do the math, right? Like,
Because you
pay
get charged for it, whether you get interest or not.
right. So if I have let's say I have a 9.75% cap, Matt, and I can pay 1% fee, and I can get a 12% cap,
Right.
right? Now, given you're like, oh well, that's pretty exciting. You look at the 9 and you look at the 12, you're like, oh, it looks pretty significant, right?
Mm-hmm.
And of course it illustrates very significant too, because they're highly inflated illustrations. But the reality is you're not going to hit that cap every single year, right? We know about 35% of the years the market is stagnant or goes down, right? So for 3 of those years, you're going to lose 1%, which is not a big deal, right?
Right.
But in order to make it up, how many years do we need to hit the 12, right? Because if we hit the 12 for 3 years, remember, we still have that fee. So we really only picked up 1%. It takes 3 good years to make up those 3 bad years. And then it's really the other 4 years. Did we even get that 1%? I don't know. Right.
Yeah.
And so I'm not a big believer in those fees. I've seen some that the spread or the bonus wasn't even that much. Maybe it was it went from a 9.75 to an 11.
Mm-hmm.
And in that case, like, there really is no
Right.
point.
What's the
Like,
point? Yeah.
you're gonna lose, right? So there is a mathematical situation where it makes sense, but again, if you only have 4 years where the upside is really only like 1.25%,
Mm-hmm.
does, even at that 9.75 and 12, it doesn't make the most sense, right? It could work out, but it's not it's not a huge thing, right? So but like I said, a lot of times I've seen where that difference that they give you is less.
Yeah.
And so if it's less than that, and that barely makes sense, obviously anything less than that doesn't. So, but this one, you can see the $657,000, or sorry, $657 charge was applied. And so this client went down, right?
So they lost money.
They lost money the
Account
first year.
value went backwards.
Mm-hmm. So they ended the
Upside
first year.
potential, downside protection of the market. Okay.
Yeah. Again, that's because they put the fee in the policy, right? So they have $104,563. And then we fast forward. Now you almost think, well, maybe this one would be a good year because, hey, the market rebounded, right? 2023 was a good year in the market. But as you can see, they started with that same 104. No interest was credited. Another fee for the index option, and they went down again.
It's a little
Now
precarious.
they're at 1039, right? Over here, again, initial was 105. So not a huge deal, but we're 2 years in and we still don't have a positive return, right?
Right.
And then we get the third year and we finally get a positive return here. So we get a $5,300 credit, and then you can see that fee there. So that takes away. So we end the third year with 108,657. Right. So 3 years in, we went from 1052 to 1086, just over $3,000 over the course of 3 years. You do the math, that's about 1%. It's about $1,000 per year, right?
Certainly not what was illustrated, I imagine.
Definitely not.
Not even close.
Definitely not even close to the illustration, right? And so, again, is it that the annuity won't protect your money? Because that's really what annuities are for, is to protect your money, to give you some potential for growth. And in that case, did this annuity do its job? It actually did, right? But this client is only 42 years old. This guy needs to increase. This is his retirement, right? This thing needs to grow, right? We can't have it just being protected. And that's the issue is annuities are great for clients that are close to retirement, that are looking to really protect their money, but they're not for a 42-year-old, or definitely not a 30-year-old. They need to still grow their assets, right? That's not.
These are not, in my opinion, these are not good. Annuities are not good long-term wealth accumulation vehicles.
No,
They're
they're
really good wealth distribution vehicles. You're not going to find a better product on the market for creating income than annuities. Just not. So why are we messing with all this? I don't.
Yeah.
Well, I know why. It's because it looks really good on paper. It's very enticing. I can see why people would want to do it, but the reality is none of that happens ever. Well, I'm not gonna say ever, but very rarely.
Yeah, I did a video with Tracy Lounsbury, and some of us like know our stuff, right? We know how these indices actually work. I'm a big believer in the S&P. There's some different ones that can work too, but most of them, they don't, right? And we can get into that too right now, but you really need somebody, if you're going to use annuities, you need somebody that knows what they're doing. Just to give you an idea, Matt, I offer annuities. I don't offer it to a 30-year-old, right? But for people that, hey, we're getting close to retirement, this is going to protect their money from that downside risk. But what I let them know is like, look, realistically, we're looking between 4 and maybe 10% on the high end. So if my client gets a 7, I'm pumped if my client gets 7%, right? Because we're not sticking all the money in there. And that's the other thing I see too, is a lot of agents want to, oh, you have that amount in a 401k. They want to take all that money and put it in there. Like, no, it's supposed to be part of a portfolio. It's not supposed to be all your money, right? So it can be a piece of it. There's some money that, yeah, you want to have some protection with some potential to grow. But then in retirement, there's still inflation risk, right? And so even a lifetime income, you still got to account for inflation. You should never put all your money into one annuity, ever.
Yeah.
I can tell you that.
Spread it out a little bit.
Yeah, you should have some market exposure. You should have some other things going on too. But yeah, that's how they're sold. And the reason the agents do it is because if they don't do it, they don't get paid. They don't get paid to put money in the market.
So what can we see what indexes this client put their allocated the money to?
Yep. So you
Because
have
this was not they weren't doing the S&P 500 like point to point. They were doing these volatility iShares, whatever.
Yep. So this one's actually a 2-year point to point right here. That's the iShares
So we put about half into that and then half into the 1 year balanced
This is the
asset
1 year
five
balance asset 5, right?
with par and fee. Okay.
Yep. And so
Which is
I'm
a proprietary volatility controlled index. That's what that is, guys. They're almost like borderline a scam. When it comes to illustrating for IULs, fixed index annuities, like these things are a disaster.
yeah, so this is the one that you got the credit from, right? So this one had a good year in this year after a couple of years of not having a good year, right? But of course, that fee was charged each year. And so what I want to do is show you, because when we talk about the proprietary indices, and by the way, if you're watching this, go check out our other videos. I have one with Tracy, I have one with Matt, where we go into these proprietary indices in depth.
Yep.
I'm not going to do that on this video, but I do want you to see that this is how the actual performance of this is. You can Google this, right? Balance Asset
Yep.
5
Balance
Index,
asset five index. Yep.
and then just go to the performance section. And this is the historical and current performance. So when you look at this, the reason the illustrations look so great is this red. This is all look back, hypothetical. It's again, it's like calling the plays after the or picking the winner after the play, right? Or
Right.
after
Yep.
the race. It's like, oh yeah, of course you can win when you know. Like we talked, I think we talked about Back
Yep.
to the Future, right? In another
Yep.
video. It's like knowing that
Yeah. Where
playbook,
Biff
right?
has the like the sports almanac, and he goes back, and now he can predict the win of every single game. That would be awesome to have, and that's what you have right here. That's the like that looks like a pretty good chart up until its inception date.
Live date is in
Okay.
green, right? So when we go right
Which
here,
was when did it went live 2021, right?
yeah, we're looking at
Or like just
2020. So,
2020.
yeah,
So
2020. So it's been live for 4 years.
yeah,
You can
but
see,
it wasn't when the client set this up because he set it up in 2021. So this index had only been around for about a year.
yeah,
We're gonna
yeah,
roll the dice with our financial future on an index that's only been around a year. That's crazy, dude.
yep. And so when you look at this, 189.22 is the price of that index when it
Mhm.
started 4 years ago, and we're at 192, 195. I saw
Right
195 in
around
there.
there. Yeah.
But either way,
Either
after
either way, it's like barely done anything.
right, right, you're talking about a overall 3.5% return over the course of 4 years, which is less than 1% per year, right? And so yeah, with like you were mentioning, Matt, a lot of these agents will be like, oh well, you're getting 240%, yeah,
Yeah.
of one.
Participation rate. Yeah.
Of
Yeah.
one.
But
Right. And
but see, here's the thing, man. Like you said before, it doesn't make this bad. It's just how this was sold to the client and how these things are illustrated is the real problem. Because there's probably a good place in somebody's formula for something like this, some type of volatility controlled index. I'm sure there's a good purpose for it. It's not it's not to illustrate 12% to a client in a fixed index annuity or index universal life policy. That's absolutely not the case because like look at this, man. This
well, the reality is
it doesn't do anything close to what is illustrated.
a lot of these indices, Matt, the reason they're created is because you have all these carriers buying options, right? Buying contracts. And what happens is you drive the price up, right? The more demand there is for something, the higher it costs, right?
Right.
By the way, the volatility, you need volatility to make money.
Mhm.
You want volatility when you're talking about options, right?
Right.
And
You have to
so
have
you have to
volatility.
have it.
Otherwise, an option strategy doesn't work.
Think about this, an option that stays stagnant loses, right? Because that
Right.
contract each minute, like each day, each hour, each minute loses value, because what it really is, it's kind of like insurance for that market. It's covering you at a certain price, and if you don't cover that price or go up, that contract ends up becoming worthless, right? And so that's really what's going on here. Is you're talking about something that needs to be volatile, but what these insurance companies are doing is they're saying, hey, let's make these proprietary indices where there's not so much demand, and we'll keep the prices of those options down so we can buy more. And the other way they do that is by reducing and controlling that volatility, right?
Right.
Because again, who wants to buy options contracts for something that's not volatile?
So yeah, exactly. So real quick, Michael, actually, I want to share my screen really quick.
Yeah.
I want to bring this up and get your thoughts on this. So I went to that exact website that you're on right now. I'm just on a different page. Let me share
Uh-huh.
my screen really quick. I want to show this to you guys and how misleading this is. All right. I want to show you. Oops. Full screen. Okay. Michael, can you see my screen?
I can. Yep.
Okay, so we're on the balanced asset 5 index. Like you can see up here, I'm on the same exact website. I'm just on at a different page here. So there's a very big difference between inception date and launch date as well. So make sure that you're paying attention to the language that that an agent's using or that an illustration is showing you, because it might say inception date, but see, look at this. October 2003. This is when, if we go back, if we were to go back to your chart, this is when they started the historical back testing. But the actual launch was June 2020. So be very aware of the language here, but then also look at this maintenance fee, 0.85%. I wonder if that is factored into, like, are these maintenance fees factored into the illustration, Michael? Do you know off the top of your head?
No, no, those typically are not shown in the illustration, right? So
This is almost a 1% fee.
yeah, the fee that the client sees in the illustration is basically a way for them to pay extra they're basically paying for extra cap space. So
That's crazy, dude. What am I doing here? Stop screen share. Okay, there we go. I'll give the floor back to you. I wanted to bring that up because, like, again, these are things that you have to be aware of if you're going to be dumping a bunch of money into these things. Like, do you know what all the fees are? Are there some hidden fees, like maintenance fees? Because that's from the actual index. That's not the life insurance company. That's the index charging the fee, which I imagine. I would hope that the life insurance company is factoring that in, like, as a cost, like maybe an admin cost or something like that. I would hope. I don't know. You'd have to ask, but also knowing the difference between the inception and launch date too, because when you see it, the inception date at 2003, okay, that's not as bad as like a 1 year old index in the case of the client when he bought it, but the launch date, like, I mean, do we really want to allocate money to something that's only been around a year? I don't think so, and not for me. Anyways, I'm not willing to roll the dice there. So, anyways, I wanted to get your take on that because I think those are important things you need to know before you put money into these things, guys.
yeah, 100%, 100%. There's a couple things that they don't have in the look back, right? In this area, you don't deal with any liquidity issues. You don't deal with it's all hypothetical, right? It's like
Yeah,
there's no emotional things. There's nothing that can go wrong in trading that goes wrong.
yeah, this is
Right.
crazy, dude.
That's the other thing too.
So,
And so,
so,
but yeah,
so we've seen. Go ahead. Go ahead.
also based on, remember, they flood to control the volatility, they will increase the cash or decrease the cash and the exposure to control that cost. So these are all things that are really hard to understand until it's actually live, till they're actually doing it, right? And so
Mhm.
that's why when you look at all the proprietary indices, they're engineered and designed to look good on paper, right? They
Right.
have the advantage of that of it history being 2020. But when you look at this, and we've done other videos on this, right? It's not just this index; it's almost
Yeah.
every single one of these indices.
Almost every single volatility controlled index that I've looked at, this is the case.
Yeah,
Significant underperformance compared to the historical look back, and obviously significantly lower than what's illustrated.
yeah. So obviously, this is not what you want to see if you're a 42-year-old guy, 20 years from retirement and you know that you need this money to grow, these are not the kind of results you want to see, right? And then it kind of gets worse. So he
Yeah.
got
So
his.
what we're about to get, this is the next part I want to get into, guys, just so we know where we're at in the process here. So we have, just to recap, we have looked at the actual performance of the annuity, which is obviously not, I seriously doubt that the agent was illustrating 1% per year. Okay. So that's a problem. The inherent misleading nature of these indexes and how they significantly underperform their historical back-tested data, that is very significant in this. And now we mentioned this earlier. The argument is, oh yeah, but you get a 250% participation rate of what? But then, like you just said, it gets worse because what do they often do, Michael? What we're
They
about to look
lower,
at.
they lower cap rates. They lower spread, or they increase spread charges. They lower participation rates. This is common practice. Like I said, it's common practice in both IULs and annuities.
Yep.
However, annuities are worse, right? They really inflate the
They
annuity
don't have
illustrations.
the same regulations as IULs do, right?
Yeah, yeah. And so at least the IULs have some regulation on what they can illustrate, right? Annuities, like I said, I've seen annuities illustrate over 15%, which is insane to me.
That's
Um,
absolutely insane.
but what this is right here, Matt, so your clients are going to do your annual reviews. You got to be on top of this because, again, things change year by year.
Mm-hmm.
And so the client got this in the mail and he sent it to me. He's like, well, what should I pick? What is going on here? And I do want to say I did not write this policy. this
I would
is
hope not.
this is an inherited client that is now just sending me all his current stuff too, right? And so
Right.
He was, if you remember, he was in this fund right here. Actually, not this one here. He was in the 2 year.
Yeah, he was in the 2 year and then the 1 year balanced index, balanced asset 5.
Yeah. So you look here, you got a 46. This is the 2 year point to point, 46% participation rate, meaning if that index does 10%, he's going to get 4.6. And it says with spread and par. So that
Right. Plus
spread is
there's a 5% spread charge, right?
spread charge, right? So the reality is if he got 10, that 4.6 would not cover that spread, right?
Right.
So he would get 0.
Which is likely why he wasn't getting any credit the first couple of years, because it probably didn't move enough to cover that, right?
Right, right. And
Yeah.
some people, I know a couple of people that are okay with spread charges. I am not one of them. I do not like the idea of the insurance company getting theirs first, right? Like
Right.
I'd much rather have a cap get mine first and you can keep whatever's after, but I'm a bigger fan of the participation rates. So, but yeah, in this case, with that spread, the first 10%, he wouldn't get a dime, right? Because you got to cover that 5% too. And he only got 4.6 out of that 10. So
Right.
it takes a pretty big return
Yeah.
to actually make money here. Now, keep in mind that is 2 years, right? So
Right.
that's about 2.5 per year, but still,
Right.
that's how it works.
Okay.
The other one he was in was the point to point
He had
balance
the par and fee. So I think it's the 145% there.
right
Yep.
here. Yeah.
Yep.
So this is the other one he was in. He's getting 145% of that index. And so if that, again, to illustrate that, that means if that index got 10%, I use 10% because it's an easy number to
Yep.
understand and multiply, he would get credited 14.5%.
Right.
Which, by the way, Matt, that's how it's sold, right? Because, if you got 10, you'd actually get like 14 and a half.
Right.
But they don't tell you, what they don't tell you is this. Well, the reality is the index
It's not
does
going to do 10%. Not
Yeah.
even
It's
close.
not going to even get close to 10%, right?
Yeah.
And so, but that's how it's sold. It's like, oh, if it got 10, you get 14 and a half. Well, that sounds
Right.
great until you realize, if you ever do, that you're never going to get 10 on that index, right?
Right.
And
But then
so,
also, so this client, they dropped his participation rates pretty significantly, correct?
correct. Or I don't have the original, so I don't know what the original illustration looked like, but I do want to show you this is what they do. They don't treat their clients equally, and this is not. I kind of rip on F&G a little bit because of their financials, but this is not just an F&G issue, right? This is
Right.
a industry issue.
Yep. This is
Um,
very, very common.
so when
What
you
we're about to
look,
see here.
this is the balance asset 5, and you look at the 1 year point to point with charge.
Yep. 230.
On the brand new illustration, they're giving you 230%,
Right.
which means they're giving the other guy 80, the current client 85% less participation rate.
Right. Imagine you've been working a job for 10 years, right? And you're making, let's just make it easy. You're making $30 an hour. All right. And then the new guy comes in, does the same exact job, sits right next to you, but he makes $40 an hour. How does that make you feel? And now what likely happened, Michael, correct me if I'm wrong. We don't know for sure because we don't have the original illustration. But this is often what's happening is they promote the 230% participation rate to new clients. And then you give it a couple of years, they lower it to what this particular client has to 145. And that is the life insurance company making adjustments to the contract to manage their risk. Okay. That's usually what happens. But either way, it's like they're treating new clients way better than what their current clients have. Like, why doesn't he get the 230% participation rate? That doesn't make any sense. So walk us through that.
Yeah, so it goes off bond rates, right? And bonds when you bought the policy, which I don't agree with because you buy options, and that's the argument, right? And that's what people say. But here's what I'm going to say: the reality is, options are bought at the anniversary date, right?
Mm-hmm.
And so whatever your general fund is doing at that time, it should affect. So in this case, rates should be going up, right? And
Right.
so I know they're coming back down, but what I want you to see is what these companies do. I've never seen a renewal rate higher than a new business rate. Let's just put it that way.
Yeah. And that's a
Right?
problem. That's a problem,
And
man.
that's a
That's a big
yeah,
problem.
that's a big
And they
issue.
did it on his real estate one too, that 2 year point to point. 70% for new clients. His was 46.
Yep. And the spread charge is lower too.
That's almost half.
Look, the spread charge was doubled as well from 2.5.
Wow.
So you're getting half the participation
Wow.
and
That
you're
is
paying double the
crazy.
fees.
That is so crazy.
And so, Matt, I want you to think about how that makes the illustration look when you're doing it at the higher number
Right.
and
Versus
and
if you were
you're
to run an in-force illustration right now for this
and you're
client, what it would
using
look like.
and you're using this red area here
Yeah.
for illustrative purposes, right?
My
And so
gosh, dude,
uh,
this is nuts.
that's why you can sell these things very easily. They will show on the illustration, 14% returns and things like that. But the reality is, as you can see, it's just not something that's going to actually happen.
Yeah.
Not that you can't get lucky, because I'll have people fight back like, well, I got this 1 year where I got 16%.
Right.
Well, you got lucky. You got
Yeah.
lucky, right? Like,
And, people hit the lottery every once in a while. You hit your number on roulette every once in a while. That doesn't
yep,
mean all of a sudden we're going to put our financial future on the roulette wheel. Okay. Like 1 year doesn't dictate and determine what we should do with our money long term. Right.
right.
We need some consistency here. And this is just borderline lying, like almost intentionally being misleading because the life insurance company knows what they're doing. Okay, this is not like an accident. Like, oops, we had a bad year, so we have to adjust things a little bit. No, they know exactly what they're doing with this stuff. And what's really frustrating to me is that just because it isn't illegal yet or regulated yet, like I just feel like we should they should still be doing the right thing here. And I look, I'm not going to say it specifically that any life insurance company has malintent or that they're trying to rip people off. It is what it is, but it's just a financial product. But the fact is, This is massively, massively misrepresented. And people are making financial decisions that it's just so frustrating. It's going to have just severe consequences long term. So
Yeah.
it's
It's
really sad to see.
yeah, when I look at companies, Matt, like this is an example of a company with like I look at it like poor financials. And then I also say reputation, right? Like how do they treat their clients, right? How is their integrity?
Yeah.
And so one thing I've learned is you trust a snake to be a snake,
Mm-hmm.
right? You trust a person to be who they are. Well, you trust a company to be who they are too. So when a company has a history of playing these games, and then you're 3 years into the policy, you get lower rates than the brand new clients get, trust them to do it to you too,
Sure.
right? Like understand in 3 years you'll be in that same spot as looking at the new clients, wondering why you're getting half,
Right.
right? And
Yep.
so the integrity and that stuff matters. And then even the fact of, yeah, let's inflate our illustrations, that matters too, right? Because not every company inflates illustrations to the same degree. Now, I will say this, most of the companies do inflate their illustrations,
Yeah.
but some are considerably worse than others. You mentioned I think we mentioned Mass Mutual. I don't remember you or me, but I saw a report, and this isn't to promote Mass Mutual or say they're the best, but they were the only company that did not inflate their illustrations.
Mm.
And I don't say that to promote Mass, but I say that to give you a perspective that basically to some degree everybody's doing it,
Yeah.
right?
Just gotta. That's why the education part of this, guys, is so important. Like, know what you're looking at. Right. You don't have to be an expert, but know what questions to ask. Know what things to look up. Like, go into these types of things assuming that there's something not there's there's a catch to this. All right. Should always assume that it's not always going to be the case, but if you go into it with that mindset, then you're going to be much less susceptible to products like these because you're going to know what to look for, the questions to ask, the research to do, and you can start to put the pieces of the puzzle together and then make an informed decision. Like if the client knew that this was the nature of what he was buying and he still wanted to do it, hey, you're a grown man, do whatever you want to do, right? You want to roll the dice, fine, I don't care. But most of the people that buy these types of things do not know, and a lot of the times it's too late to do anything, or to do anything without taking some type of pretty big financial hit. I don't know what the options are, what you guys are working on to get him out of this. If you're going to do a 1035, or maybe it's too early, because there's surrender charges oftentimes with these things too, so you got to be careful with that. But the key is just make sure you're doing your own research and you know what to look for, because like this stuff is happening across the board to just so many people. We see this on a regular basis. This is not a one-off, guys, so please just be careful out there. So Michael,
Yeah.
anything else you wanted to share? Any final thoughts
Yeah.
to wrap up?
Couple things. Beware of longer annuity terms. A lot of times you'll see like a 5 year, a 7 year, 10 year, even a 15 year. Remember, those are there's surrender charges. That's what they're. When you see a number at the end, that's the surrender period, meaning
Mm-hmm.
there's a surrender charge to take your money out.
Right.
And when you have a 5 year or a 7 year annuity, that surrender charge might be 7, 8, 9% that
Mm-hmm.
first year,
Right.
right? And then it goes down year by year. When it's 15, I've seen some of these charges 15%. And so
That's
imagine
crazy.
being locked into a contract, and that's the situation here. This is a 10-year annuity. And so we're 3 years in, right? Meaning there's a charge for the next 7 years.
Yeah.
And in order to get his money out, he either has to ride this out, which
Yeah.
we projected he is probably going to get between 2 and 3% on average going forward based on the new participation rates and cap rates. So that's not very acceptable for 7 more years for a 42-year-old, right? So we said, okay,
Right.
well, we need to figure out how to get him out. And we did. We moved him into a self-directed IRA, and he's investing his money a little bit more aggressively through that, but also in a safe way too. But he's going to get better, much better returns, right?
Yeah.
And we did that, but we had to take a loss, right? Like sometimes you got to cut the tie. You got to just take a loss. So there
Just
was
think
a
of it as a
surrender.
learning lesson.
There was a surrender charge, but the other part was there's a second charge in there, and I'll show you. I'll pull that up right now.
Wow, surrender value of 94.8.
Yep. So
he took about a $10,000 hit, give or take.
Yeah. It was per 13,000.
So what's the other charge?
So the other charge is right here. They call it market value adjustment, right? And so not only did he have a surrender charge, but he had this market value adjustment, because the surrender charge is, when you look on the contract, I think it was a 6 or 7% surrender charge. But when you look at his actual surrender, Matt, he had 108.
Right. Mm-hmm.
Well, that's significantly more than 6%, right?
Wow.
His surrender value was 94.8. And so that's because of the market value adjustment. What they are doing there is, if the surrender charge wasn't enough, they just want to make sure that the money's in there long term.
Mm-hmm.
It's supposed to be a way for them to protect the rates, but then you still see the rates drop. So
wow. I've never heard of that, Michael. I've known about surrender charges, but you see it right there. If you were to surrender or cash in your contract, you may incur surrender charges and any applicable market value adjustment.
Yeah,
that's crazy.
This is basically
$16,000 there.
Yeah, that's basically the surrender charge right there, the 668.
Right.
So some of these contracts have additional, basically, charges. If you try to take your money out, they're going to adjust the value of it. So that's another thing you got to be aware of. So to move his money, he had to take a $13,000 loss. That's almost $14,000 right there.
Ouch.
He did it because the reality is getting 2% for the next 7 years just isn't going to cut it, right?
He'll make it up in the long run. That's the idea. Sometimes it's better to take the hit and just move on, but it still hurts. It still sucks, because you're promised this thing, upside potential, downside protection. Look how good this thing looks on paper. This is the 401k destroyer. 401k is a scam, blah, blah, blah. Dude, a lot of the times with these things, especially these proprietary indexes, you're far better off in the market from what I've seen anyways. So that's crazy stuff. So just be careful out there, guys. Make sure you're doing your research. Michael, I really appreciate you being on and sharing this with me. I have a feeling that we're going to be doing a lot more of these over the years, unfortunately. So we're just going to keep doing our thing, getting the word out, exposing these things, that like, and uncovering, just bringing to light the things that agents don't often disclose to people, because if they did, they probably wouldn't sell it. Like, who in their right mind, if they saw this, would want to buy one of those annuities? I certainly wouldn't. So just be careful out there, guys. I hope this was helpful. I'm going to link down to Michael's YouTube channel as well. And Michael, if you want, send me, well, I'll just get it off your channel. I'll link down to your interview and podcast with Tracy. I'm actually going to go check that out, where you guys broke down all the other proprietary indexes. I think that would be really good for you guys to check out. So I'll link that down below. And make sure you subscribe for future videos like this, because we're going to be probably doing a lot of them. So just stay informed, guys. Do your research. All right. Be careful out there. Hope this was helpful. If you guys have questions, drop down in the comment section below. And we'll see you on the next one. Take care, Michael. Appreciate your time, buddy.
Take care. Thanks for having me.
Yeah, man.